Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. It is Monday morning, July 24th, and this is The Talking Point. Thank you for joining me. It's a very important week for the markets, given the raft of important earnings and also the Federal Reserve meeting this week, not to mention the Bank of Japan meeting and also the European Central Bank. So it's a week for the market, a market, by the way, that has done very well, as everyone knows, and also, though, is in what we would call near-term overbought conditions. I talk about this very often in this call, oversold and overbought. Overbought typically means, however, that the market has done really, really well. The enthusiasm for this market, as demonstrated by the number of bulls, retail traders and investors, much more bullish than they have been, pushing the market higher. That typically moves towards an overbought situation. Now, as I've said many times, markets can continue to be overbought just as they can continue to be oversold. But normally, typically, there's a catalyst that hits one way or the other that helps to push the market higher or pulls the market back to digest all of those gains. And we'll see this week, because this week there will be a number of catalysts for the market. First of all, last week we heard from Tesla and we heard from Netflix. And you know, the market is richly valued at this point. And so many you'll hear say, well, it's priced for perfection. But what happens then is that the market becomes less forgiving if there's any scent of a disappointment. And in terms of Tesla, it had to do with the possibility that he would have to, Elon Musk said that in turbulent times, we may have to cut prices. Also, there was a little bit of pressure on those margins. We talk about operating margins. There was pressure there. And so the market just, pulled back on Tesla. With Netflix, actually, it was interesting because they did well, but what missed was a miss on the top line revenue growth. There's a consensus estimate for how much should come in, and Tesla and Netflix came in just a tad below that, and the market punished Netflix. Nonetheless, the markets have moved on, and the markets are looking for the big tech earnings reports this week, and that will include Google, Alphabet, Meta Platforms, and also Microsoft. So these are very much anticipated, and Microsoft especially, because it is most closely associated with, you've got it, artificial intelligence. And so the market wants to hear, what are they saying about conditions for continued development in artificial intelligence? What are their customers saying? What are their clients saying? The market wants to hear that, not to mention the cloud services, which is an important part of the makeup for Microsoft's earnings. So the market is going to be very cognizant of what they have to say. Similarly, the market is going to focus on what Alphabet has to say, Google. One thing that is important is advertising revenue. It had come down. The market is expecting, doesn't mean it's going to happen, but the market is expecting that advertising revenue will pick up. But here, too, the question is, how deep is the development moving along with, yes, artificial intelligence? Similarly, with Meta Platforms, the market rewarded Meta. Every time there was announcements of cutting headcount, the market rewarded that. But right now, the market is focused on, what are you doing in terms of AI, artificial intelligence? Not to mention the competition that Twitter has now with Meta's version of Twitter. So all of these are going to be important for the market to digest. But in addition to all of that, we have another raft of earnings coming from Procter & Gamble. And I'll tell you here what's interesting is, does Procter & Gamble still see the customers paying up for the name brands? Or are they seeing that customers are, moving away from paying full price, if not higher prices for those name brands, and possibly moving to brands that are less expensive, sort of those off brands? That's going to be important to hear from Procter & Gamble. They've done very well with raising their prices and having consumers continuing to pay those higher prices. Coca-Cola similarly this week raised prices last quarter. Folks were buying the product. So we want to hear, is that continuing? And also we'll hear from McDonald's. That's obviously not just here in the U.S., but also their operations outside of the United States. We're going to hear from a couple of big integrated names in energy, Exxon and Chevron. And what's interesting here is that we have heard from overseas energy companies that they have been doing well despite the lower price of oil. So we want to hear what Exxon and also Chevron have to say in terms of what they're doing, in terms of taking, being able to navigate the lower oil prices. With Visa and MasterCard, this is going to be interesting because what we're going to be looking for here, Visa and MasterCard, are what are the provisions for loan losses. We heard from American Express, and American Express upped their loan loss provisions, and we want to see whether or not Visa and MasterCard. American Express is more closely associated with a higher income user of their cards, and also business users use American Express. So what are we going to hear from Visa and MasterCard? This is going to be important, again, for the market to absorb. So all told, within that space, and there are obviously many more companies coming out, but I thought I'd highlight the ones that are of particular interest to the market. We also, this week, are going to have housing-related data. New home sales, Case-Shiller. In addition, we're going to see pending home sales. All are going to be very important for how the housing market is holding up. The housing market, which is most closely associated with yields. How much do you have to spend with the 10-year Treasury? This is important because the housing market and related stocks moved higher and higher, as if looking at the Fed nearly finished. And then when the bull market was born, literally when the bull market was born on that day, the housing-related stocks were part of that surge upward. Now, there's an old expression in the market, and that is that the market gets the news before the economy adjusts. So that was the market, in essence, saying, we see the Fed beginning to talk about the finishing up of its rate hike campaign. That's what that move was, that we're going to see that. It's the market doing its job. The question now is, how does the housing market relate to what the Fed has to say on Wednesday, when expectations are that they do raise rates, but the commentary is going to be important. Not just for, by the way, the housing sector, which is so closely associated with rates, but also the currency market. How is the dollar going to respond? All of these are going to be extremely important when the Fed comes out with its announcement, and that's the statement, and what Chairman Powell has to say at the press conference. Also this week, which is also going to be extremely important for the market, will be the durable goods report that comes out on Thursday. And why? Because embedded in the durable goods report, the core durable goods, is a component that is associated with capital expenditures. What are companies spending and how much are they spending? And this is something the market wants to see and pays attention to, because so far we have seen that companies are actually continuing to budget for capital expenditures. That's a very good sign for the overall economy, is it not? And then in addition to that, on Friday, and this I can't stress this enough, this will be the Fed's preferred measure of inflation, and that is the core PCE, Personal Consumption Expenditures Index. That is very important. And so obviously, all focus will be on the core part of that, because we know what the headline, but what the Fed is focused on the core. So this is going to be important to see if we're seeing that also edge lower, the way the consumer price index edged lower. Even the core, the super core, began to edge lower. I mean, it's untangling, but it's still sticky. We'll see what happens with on Friday. I want to add, too, that one thing we will have earlier this week is the ECI, and that is the Employment Cost Index. This is basically important. It has to do with wages. And remember, wages still are high. And the question becomes, how are companies absorbing these higher wages? Fortunately, wages are not escalating that much, but they did edge higher in the last report. So employer cost index is going to be important. The Fed pays attention to that particular survey. We'll also have consumer confidence, and I do want to add, consumer confidence has been climbing higher. One report after another suggests that consumers are feeling more comfortable with the future. However, along with the future, they are also seeing higher inflation over, say, 3 years and 5 years. That's something that the Fed does not want to see. So all told, this week, the market has quite a bit of data, quite a bit of expectations, and the market is going to have to adjust to what the market's response is. Particularly on the equity side, the share side, it will be about Microsoft in particular, and obviously Meta, and obviously Alphabet. And then, of course, the Fed. But I do want to say that the European Central Bank is meeting, and the expectations are there that there will be another rate hike. However, what the market wants to hear is, well, what is the probability for a pause? Let's remember that the European Central Bank is what we call a rules-based central bank. It only has one mandate, and that is price stability, which is 2%. And therefore, it has to get to that level, and it has to raise rates. That's what the rules mean. So again, there has been divergence at the European Central Bank, just as there is divergence here at the Federal Reserve, between those who say, well, maybe we can pause a bit and just see how the economies how they're faring. Well, there's a slowdown in the Eurozone, and the question is whether or not it leads to an actual recession, as opposed to the technical recession of 2 quarters of negative growth that we have seen. So a lot riding there. And then also we're expecting to hear news out of China, perhaps, of what the Politburo, that is the leading Communist Party, right, the leadership in it, what they intend to do to help the unemployment rate. The unemployment rate on the urban basis is just under 6%, but 21% of that happens to come from the youth unemployment. And that is a concern. It's a concern because you don't want the young people to feel as if they don't have a future. And therefore, we want to see if the Politburo comes up with some kind of fiscally stimulative platform. So the market is paying attention to that. And by the way, there are ramifications of what the Politburo will have to say in terms of, for example, the Eurozone that has strong trading ties with China. That could be a major benefit for a slowing economy within the Eurozone if China does offer an underpinning of a stimulus program. So it's a global focus this week, but nonetheless, even if we were to extract just the United States and what's going on here, that would be enough for the market itself to digest. So we're going to be busy. The market's going to be busy, and the headlines are going to be busy. We'll be back next week. Thank you all so very much. Have a very good week. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are or generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.